Hello, everyone, and welcome to the International Conference on Business and Policy Studies. My name is Dr. Ather Azim Khan, and I'm one of the speakers in this conference. I'm currently working as Professor and Dean of Faculty of Management and Administrative Sciences in University of Sialkot, Pakistan. I have a PhD degree in microfinance, and I'm also a fellow member of Pakistan's Institute of Cost and Management Accountants. I've authored some books and I've published several research articles. My main areas of research are investments, finance, microfinance, trade, poverty. I have about 29 years of work experience in academia and corporate world. I've worked at University of Central Punjab, which is one of the largest universities of the country, as Dean Faculty of Commerce, Director, School of Accounting and Finance, Associate Dean, Faculty of Management Studies, and Director of Volunteers in Service Program. I was the Chief Editor of research journal Paradigms for about 16, 17 years. I was the co-chair of the International Conference on Business and Management. Currently, I'm the chief editor of research journal of University of Sialkot, that is Review in Business and Economics. I've been a member of several national committees and boards, such as the Committee for the Review of the Parameters to improve the quality and promotion of research journals, the National Curriculum Review Committee, been a member of several selection boards of private and public sector universities. I'm external evaluator of FMAS programs, relevancy cases by the Higher Education Commission. I was a part of the Joint Consultative Group for Research Journals. I've been the member of the Budget and Finance Committee of the Education Endowment Boards in the country. I am an approved PhD supervisor and a trainer for government and private organization for the editors of research journals, and also a trainer, certified trainer of UNODC. All right, now let me share my screen with you and start our discussion on the topic of today, which is the examination of various behavioral factors which affect investment decisions, with the moderating role of financial literacy and mediating role of risk perception. This is co-authored by me and my colleagues. When we look at the traditional finance theory, we find that investors make rational investment decisions. This is what is generally perceived, but practically it is not true. Investors should make rational decisions, but they are actually influenced by various behavioral factors. So in this study, we have seen the impact of those behavioral factors, those behavioral biases on the investment decisions of individuals. Further in this study, we have considered the missing link of risk perception, that how risk perception actually mediates the relationship of the biases, the behavioral biases, and investment decisions. And also we have considered financial literacy, which is an important area for countries like Pakistan, where most of the investors do not have that level of financial literacy which is required to make good investment decisions. So the moderating role of this variable is also taken in this study. Structural equation modeling technique is used to establish the link, and we found that most of the behavioral biases had a significant impact on the investment decisions, except one, which is loss aversion bias. The problem of a research problem why this work is done is that individual investors should be rational, and it is considered that they should make decisions on the basis of whatever information they have. But in reality, they do not do this. Rather, they follow what is called the herd mentality, that what everyone is doing, they would just go for it. And that is, they look at the volumes in the stock markets, that the stock markets are putting more, the investors are putting more money in one stock. Others would also like to go for that because this is considered to be the trend. So these are some of the biases which are there in making investment decision. Then when we look at the security analysis approaches like the fundamental analysis, talking about the strengths, internal strengths of a company, and the technical analysis, which is about technical trends of the past, emerging and leading to the future. And finally, the efficient market hypothesis, which says that nobody can earn extra profits out of it. So, investors make wrong decisions. So this research actually is to help investors understand that their behavioral biases actually impact their investment decisions, which results into making wrong decisions and not be able to earn the desired amount of profit that they want. This study addresses some of the research questions, the gap which is existing, such as why do investors get losses if they behave rationally, using information if trends can be projected, which is about technical analysis. Why do trend analysts not beat the market if the markets are efficient? And why these investments crash are addressed in investor psychology remain unanswered. So these are some of the areas, because we say that investors' emotional, psychological, and even cognitive behaviors affect their investment decisions. So this study actually fills this gap. In this work, we have addressed two main questions. Number one, are investors directly or indirectly influenced by their behavioral biases when they make their investment decisions? And the second research question is that does this relationship significantly change in the level of financial literacy, which is a moderating variable taken in this. So if we look at the significance of this research, we see that the existing knowledge by investigating the relationship between behavioral biases and investor biases through risk perception, it is not there to that extent, particularly in the area, geographic area that we are referring. And so as a result, investors are not aware that they are making wrong decisions on the basis of some of the biases which they have, but they do not know about it. So the findings of this research will help them understand their behaviors, what is wrong in their behavior, and how can they improve their investment decisions and make better investments. This research is based on two theories. The first one is the prospect theory. This theory states that the emotional impact caused by losses is more than that of gains or profits. So therefore, if investors are given two equal choices, they would prefer one which is in terms of perceived gains and not in terms of their perceived losses. The second theory, which is the basis of this research, is the bonded rationality theory, which explains that individuals make decisions based on imperfect information because they have limited time, they have restrictive cognition, restricted information. So their financial and economic decisions are not constrained to rational choices. This is the model. You can see that we have the independent variables, which are the biases, different behavioral biases, the four of them which are taken in this study: overconfidence, herd behavior, loss aversion, and mental accounting. Risk perception is mediating, and financial literacy is moderating the impact on investment decisions. These are the hypotheses. The first four hypotheses are related to four individual behavioral biases that we have considered, and the fifth one is about the collective impact of it. We'll see that whether they're accepted or rejected at the later part of our presentation. And then you can see that the first from 6th to 10th hypothesis, we have got these related to the mediating role of risk perception. And the first 4 of these 6 to 9s are about individual mediation between individual behavioral biases and the investment decisions. And the 10th hypothesis is about the collective impact, the mediation between the impact of all of them. And finally, 11th hypothesis is about the moderating role of financial literacy. In this research, primary data was collected using a questionnaire from about 367 responses which were collected from individual investors on which this study is based. Smart PLS was used for analysis. Convergent and discriminant validity of the questionnaire was seen, and then composite reliability, average variance extracted, and factor loadings were also checked before making decisions. You can have a look at this table where the results of composite reliability and average variance extracted. Likewise, this is about the correlation, HTMT, among the dependent variables, the mediator, the moderator, and the dependent variable. These are the values of R-square and adjusted R-square. And here we can see the path coefficients, the results of smart PLS, where we see that there's just one factor, which is loss aversion, the one of the behavioral bias, which is found to be insignificant. And this may be because we are talking about primary data collected from a group of investors in this region. So other studies may also find this one variable also as significant. So people should work on it and see that. And other behavioral biases which are not considered in this may also be seen. Now, if we look at the mediation, we find that every link shows that mediation exists. In case of loss aversion, which is interestingly one variable which is not found significant, there is full mediation, but for all others, mental accounting and low overconfidence and herd behavior, we see that there is partial mediation, and overall impact of all behavioral biases and impact investment decision, we see that this perception is mediating partially. Now, on the basis of this, we accept 10 of these 11 hypotheses. And we can see that all the behavioral biases except loss aversion are accepted. So behavioral biases do have a significant impact on decision making. Risk perception, it does mediate the relationship. So we need to consider this, and financial literacy is also that moderates, so it needs to be improved among the investors. So on the basis of this, we conclude a few things. Let's have a look at them before we end our presentation. Retail investors' behavior on investment decision is under research. We need to work on it, particularly in the areas of the world where we are living at the moment, the South Asia, Pakistan, and the countries around it. And researchers may need to examine different biases and their impact on investment decisions in depth, as we have considered only 4 of those behavioral biases. Behavioral biases in risk perception determine the moderating impact of financial literacy. The behavioral biases significantly affect the decision-making of retail investors. It also explains that herd behavior is the most critical variable influencing retail investment decisions. The results verify that the investor's financial literacy partially moderates the relationship, and the relationship between behavioral biases and risk perception in the light of financial literacy is also proved. Thank you very much. Before I end my presentation, I would just say that the findings, the conclusions of this research actually help us as investors to make better investment decisions and to make more profit out of it. And as investors at times, we do not realize that we are influenced by some of our biases. But the results of some of the studies like this help us determine that we are not making rational decisions. So as a result, we start making rational decisions. So I'm stopping the screen share, and I thank you for listening to me. And I hope and I wish that we'll have a very good conference, international conference in business policy and study. And thank you very much, and God bless you.